Good morning. Welcome to Equity Story Trade Watch, the 3rd of May, Wednesday. We've got here Claude with me. We're going to talk fundamentals, of course. We're going to have our session on thought of the week, which is interesting. It's all Claude's idea, so I like it. So let's talk about that. And that will be directors buying their own shares, what companies, what do we make of that, some of these companies. So it'll be interesting to have a quick chat about some stocks. Before I do that, you've got a disclaimer in front of you. Of course, everything we talk about today is just going to be general in nature, which means that every stock is going to be based on fundamentals and technicals only. All right, I'm going to flick off into the charting, and I'm going to start with just talking about, obviously, yesterday's surprise interest rate or cash rate hike by the RBA, which threw the market off. And there was obviously a bit of a free fall in some stocks yesterday, possibly a bit of follow through today. The markets in the US weren't great either, so it's just not looking fantastic this week so far. And there's announcements this morning, so I'm just going to go through some announcements. And unfortunately, I don't have much good news for you either. So I'll go through the charts and you'll see exactly what I'm talking about. So let's start with JB Hi-Fi, which came up with an update on their sales. And look, it's a dividend stock overall. We're not super interested in the story, but as a dividend story, we do potentially, we've got it in our portfolio. On our website, you can have a look at that. Not on our fund, but on our just website, Play Portfolio. You can have a look at that as a dividend story. But other than that, it's okay. Nothing great. I think the sales were fairly flat. So overall, you can see struggle streak right now, interest rates going up, maybe struggle a bit more. So just watch the charts, but other than that, nothing to get excited about. Next one.
I'm not big on retail at the moment. I think it's always the first one to see its actual earnings go down when things slow down.
I agree. However, this is probably one of the best quality stocks.
Agree. Put it on the retailers to buy when things get hit.
Exactly. Now, Lindsay, I'm not sure if you saw that one. We like the story. There's a new CEO come through today. They've announced a new CEO, ex-Toll, couple of other companies. So it's pretty good. It's outside of the company, which is interesting because, normally you want to see someone maybe internally being promoted and so on, but they've gone outside of the company, someone with a lot of experience, but it looks like a good sign up. So for me, I don't mind it. I think the market's saying, okay, nothing to see here. It's not moving today at all. So
I think the bigger risk is, when you're losing a CEO and often the natural temptation of people is to always go out on a high.
Yeah.
Right. And so that's always a risk. However, when it's a 20-year CEO with his name on the company, who still owns a lot, then it's probably less of a risk.
I agree. And it has to go sometime, right? You can't stay there forever.
But you got to watch out. You got to watch out for those CEOs that own 1% of the company, 2% of the company, run it for a few years, get things going well, and then the share price finally takes off, and they're like, "See ya."
Yeah.
I would like to hail my fine success.
And the other thing I'm always worried about is complete change of direction. When a new CEO comes in, it's oh my God, right? Especially when things are going well.
That's the thing, right? I don't think this is the case with Lindsay, but it can be the new CEO has just put off all the spending that needs to happen. I said the old CEO. And so the new CEO comes in and is like, all right, let's take all the pain in the first half because I'm going to be judged against the beginning of my tenure.
Yeah. So look, it's down today 3.3%, but I think it's more the market related than anything else because it's actually sort of gone back up again a little bit. So it's actually not bad. This is not bad action. I don't mind this at all. All right, let's go to the WA1, which is really one I like in the resources space because of its very big potential on this niobium thing, right? So I really like this. I'm just putting it on a daily just to see it's up 2%. They had a presentation today. I'll put it back onto the weekly so you can have a look. And it's probably one of the very few that I'm probably thinking of maybe adding to the fund because I just got big hopes for this. One of the highest grades I've ever seen in niobium, and it's used in green energy and is used in lithium batteries and so on. So it's steel production as well. It's a niche metal, that's for sure. It's not something unbelievably big and so on, but it could be a winner here. So I'm looking this one with interest. RHC came up with an update as well. I don't think the market was too enthused on this. The chart looks terrible, so I'd be selling that for sure. That doesn't look great. It's actually going lower today. No, sorry, put it monthly, put it on the daily. Today's reaction wasn't anything incredible, down 2.5%. So there you go. Even though talking it up, the market's not getting excited. This one's the good one today, Claude. And you know what? We're talking about the travel and leisure space. It's actually looking good. So it's almost like an upgrade today from them. Talking about the narrowing the previous guidance, but the narrowing down is actually at the top of the guidance, and they've actually moved a little bit above the guidance of the narrowing. So it's quite interesting. That's why we like the HLO. FLT is quite good. It looks like it's still looking pretty good, right? So for me, that's the space to still probably be maybe having your money in and see if we can make some money. Although it's coming out to some pretty strong resistance around here.
I think you've got a. Oh, sorry for interrupting.
No, let's go.
Oh no, it's just like on a momentum level, on an earnings momentum, not just share price momentum. I'm all for it. Yeah, like all for the trade in these ones. But on a fundamental basis, I just wanted to point out, like half the stuff out there, like a lot of stuff that say, for example, some stuff in retail and construction, it's really trading like we're going to get a recession. But I don't understand, like surely these travel stocks are going to get whacked in a recession as well.
You'd think, wouldn't you? But everyone's traveling anyway. I don't get it.
Yeah, I mean, it's just the stronger narrative right now is like the pent up demand travel coming out, but that maybe just fizzles after a while and you get a recession on top of it.
Well, maybe look, people going, okay, I'm going to travel to Europe this next couple of months, and then you've got this RBA rating raise. Maybe having a second think, thinking, hang on a second, I got to pay more for my mortgage. Maybe I will stay home. Just never know, right? What's going through people's mind with the interest rates going up?
We keep on having children that gets in the way of my European travel.
Right, there you go. Anyway, I just want to have a look at HLO as another one. Yesterday, that I think we didn't talk about it, but they picked up 40% of a travel agency in South Australia. So it's still decent, and I still obviously like the company overall as the better probably play than a FLT. But anyway, Hub, I think they've had an acquisition today. So I'm not sure if you saw that today, Claude, but let's just have a look at the chart. Not too bad. It's actually above trend. Have you looked at it? Did you see it?
I saw it, but I'm not familiar with it. I haven't had time to have a dive into the acquired company, My Prosperity. But it's going to operate as a subsidiary retaining its own corporate brand identity and Melbourne team. So basically, My Prosperity is a secure client portal connecting financial professionals and their clients. So not far from what Hub does. And its companies its customers, a big part of accountants and financial advisors. So they've got the same sort of customer base, and it already has integrations with Hub24 itself and Class, which is another brand they own, which used to be a separate company as well, which they've bought. So they're kind of rolling up stuff. They're rolling up software that is used by accountants and financial planners to invest on behalf of clients and often, for example, manage their SMSFs. So I'd say if there's one mega trend you want to consider for Hub24, it is the SMSF trend. Now, that has been a trend in years gone by, but you have to worry, rule changes can make it harder or easier to do an SMSF. And I think, generally speaking, the Labor governments are against SMSFs because they want to just shove people into the union-controlled big super funds. Now, those union-controlled big super funds are often quite good, but there's just some risk there that these guys could get hurt from that. Having said that, when you have a Liberal government in there, they obviously hate the union-controlled super funds, so they're all for the SMSFs.
All right, fair enough. Look, I don't mind. It's actually above trend, so if you're in this, technically a hold.
I like Hub. I like this business as well. I think it's investable quality business.
Definitely. I agree with you. NWL, Hub, both actually quite good. So Hub's probably the better chart for sure. So technically speaking, this is the one that you'll probably be playing.
And also, I feel like interfering with people's SMSFs, which is their retirement vehicle, is likely to get a pushback. Labor's probably a bit chastened from how they got. They went to the old election a few years ago with the old franking credit reform thing, and didn't really win any votes from that.
Agreed. All right. So next one, SOP, Cinetech. Do you know anything about this one? Because the chart actually doesn't look too bad at all here. I saw that update today, small revenues, but, you know, up 20%, I think they've said. It's too early for me, but the chart looks interesting. Do you know anything about this one?
I don't actually, no, not across that. Maybe we need to add that to the list.
Yeah, I think we do need to have a look at this one because it's at least it's got some revenue. So at least from a fundamental point of view, I'm going to flick through it, see what they do. But you know, that caught my eye, the 20% up on revenues, small revenues, but the chart looks very decent. So potentially maybe there's even a bicentennial building by the end of the week. So one to watch.
They did one thing to keep in mind as well. They did recently raise capital through a placement, $8 million at 22 cents per share. So just something to keep in mind there in terms of how it trades.
Oh, that's interesting because it's actually way above that. So that's beautifully by done.
Yeah, it's holding above that. So yeah, well, let's see. That's really just happened. So those shares with that placement have not yet hit the market. Yeah. Or they're not yet tradable. So we're going to see if the people that they sold those shares at 22 cents, they could turn around and try and exit for a quick profit.
Okay. All right. Next one. Meek, really underwhelming announcement today. I mean, it's so underwhelming that you've got to run for the hills with this one. If you haven't sold out yet, which you should have, you should not be owning this. We've talked about it before many times. You know, technical saying get out. And today's update on resource for St. Anne, 20,000 ounces. I mean, come on, guys. It's not even worth actually putting out an announcement for that, to be honest. So it's just, yeah, looking pretty sick. And really, you'd be very disappointed with that announcement for sure. So it's been actually, I have to say, it's fallen from grace for me since that initial upgrade I think they had 2 or 3 months ago. It's just been underwhelming after underwhelming after underwhelming announcement. So for me, it's done and dusted. It's just not going to come back as a dog. All right, let's move on to the next one. AMC, another one, run for the hills. Downgrades, which, you know, talking about, they've obviously set themselves up because they talked about that, you know, they had some little bit of headwinds, but that now chart just looks, no, get out. Technically, you should not be in there anyway. It's below trends, but today it's just giving you a further incentive to just say goodbye.
I think, can we see the long term of this one, Peter?
Yeah, absolutely. Let's have a look at 10-year. So actually not bad, but it's broken the trend.
So my argument here with this one is that it's actually a dangerous one because of this long-term performance. This is widely considered a pretty high quality business, pretty defensive, pretty good quality business. Mm-hmm. But, you know, I would sort of argue that over the course of time, it's not like, so it's not as good as I would argue people think it is. It can just end up being massively impacted by the fact that it has $9.9 billion in long-term debt. That's huge. Now, yes, its market cap's over 20 billion, so it's a big company. But this is a leveraged company, right? They definitely, to me, stand out as a company that you would definitely think that there's a real possibility that they end up getting hurt by having to refinance at higher rates and also pay high interest rates. Now, I'm not totally across their actual, you know, debt situation and when that might hit, but I just think, you know, it's a weird one because most of the time when you get people going, oh, quality blue chip kind of company, it's not loaded up with debt. I guess, you know, a exception to that potentially is CSL, but also, you know, CSL really made itself stand out when it just used heaps of debt to buy back shares over years, and then it turned out like that paid off as an investment. CSL itself, you know, has like way more advantages than it's not making packaging, you know, it's making blood products that are crucial, cannot easily be replaced. And also CSL, arguably one of the best companies on the ASX, has, I think, about $7.5 billion debt. And, you know, Amcor has 9.9. So I just don't see how this thing actually is that quality of business, but I would worry because it is considered a quality business.
Yeah, look, I think just looking at it very simply, right, in a rising interest rate environment, you don't want to have really too much exposure into stocks with high levels of debt. They have to obviously pay interest on that. So it's not going to be positive for them. I mean, that's just simple as that. So I'd say investors are probably looking at better quality stocks, like you said. This is for me not quality either. I mean, low margin, slow growth. There's nothing really to get excited about here, really.
Debt to equity of 171%. You know, this is not. This is not that good. Like, there's no it's not a good solid kind of one there. Sometimes there are companies that can really load up on heaps of debt. Like, I guess healthcare infrastructure kind of companies, REIT style things, all that sort of thing, security against property, that kind of stuff. But yeah, I don't know. I guess it's okay, but not great. And I'm a bit worried about the fact that people think it's great.
Claude, that red candle says get out. And if you look at the previous sort of moves below trend, it can be under the trend for some time. So even though it might not, go down to $8, whatever, because, there's maybe the perception that it is a still quality story by some circles out there. And maybe in a recession, maybe it's not that bad, right? Because it's still have to package food and so on, whatever. It's just probably going to languish. That's the thing here.
That looks like one of the biggest drops, though, below the trend lines that you have seen.
It is because of the downgrades, right? So that's the problem right here. I'd be getting out.
I'd be out of it as well.
Yeah.
And if I was still a shorter, I would even probably consider shorting it.
All right. So that's not a good one. All right. And last one I've got for you. So you can see not very good news today at all. ARB. Let's look at that one. Updated the market. It's actually not too bad, but the actual growth is done and dusted. If FY23, because it's just not there, it's gone backwards. It's had a really good period. It's been a great story for a long time, with the really big boost from COVID, but FY23 is going to go below the previous corresponding period. So it's not brilliant, but you know what? It's still not too bad. So overall, I still rate this company quite highly.
It's good quality management team, long-serving founder, owner, managers, good quality business, distribution / retail kind of business.
Yeah. It just might go public for a little while. That's
it just got a massive over-earning bump in 21-22.
Correct.
And
it's expensive, right? That's the other thing.
Yeah, I'd probably just wait a couple of years, let the earnings return to, like, I guess they're more long-term trends, and then pay a multiple of that at lower earnings. And I still suspect these guys do a good job.
All right, I agree. So there's not much fantastic stuff today, but let's turn into our thought of the week. And suggestion was directors buying, and I love that because the thing is that usually gives you a good indication of, is there interest in this story? Is there something that's going to happen soon, right? You wouldn't be buying your own shares unless there's some good news ahead, or maybe you're comfortable and confident in your company moving forward. So that's the idea of it. So tell me, Claude, what sort of companies have you come up with that we can discuss today?
Well, first let's chuck up a couple that I thought that maybe at least you wouldn't mind the chart. So the number one would be TAH, Tabcorp.
Yep.
Now, the reason that there could be a trade in this, of course, is that it's more considered a bit of a, like, I guess you might try and look at it as like a dividend stock, for example, or a value stock, that kind of thing.
Yeah, it's very defensive. Look at it. I mean, the market's really going backwards, and these guys are, we're fairly safe because people are going to keep gambling pretty much. So at the end of the day, it's a definite dividend story, definitely defensive in a market in a recessionary type period. So you can understand maybe why directors are buying in this space.
Yeah. So I think that's like a resilient-ish kind of business. Yeah. And with director buying, and now obviously I personally am not big on gambling stocks.
Neither am I. So it's not for me, but there could be some interest out of the dividends. Actually, let's have a look at what the dividends actually are in this.
That's what I was just getting up as well. Like, what's the forecast dividend? Hold on a second.
Let's have a quick look. So the dividend on Tabcorp is 10.37, and that's that's fully grossed up, right? Yeah. So probably about 7%, something like this.
But they did have a demerge and stuff lately, so I'm just wondering what the forecast will be, because that might be different. So they're looking at, the forecasts for going forward into 2024, to my surprise, actually only seeing the forecast say either 2 or 3 cents dividend. So maybe it's not going to be it's not sustainable. Yeah. So, but having said that, maybe the reason a director buying is because these forecasts are too modest. So yeah, let's see what happens there. Not necessarily like an absolute layup obvious winner, but also I feel like it's probably the chart looks good. There's a bit of director buying. It's sort of semi-defensive, so maybe it's all right.
Absolutely. So I think maybe that's what's happening here. All right, give me another one.
All right, let's do DDR, one that I actually quite like. I don't own it myself at the moment, not saying now is the time, but it's actually a good, good management team and stuff. They've seen a little bit of buying, but yeah, the chart's still pretty ugly there.
Yeah, absolutely. So obviously that's director buying. This is the course, the CTM course, because it's just no idea when to actually buy it.
Yeah.
It's look, I when I see a director buying when your share price is languishing, he obviously thinks that this is a good value around these levels, right? He doesn't care about the chart. He just thinks that the next month they might recover here.
This is an interesting one from a management perspective. The COO and the CFO who run the day-to-day operations of the company, they're both very well paid, by the way, high salaries, deservedly so. Their performance has been very good, but high salaries, and when you compare the purchases versus their salaries, you know that they're all right, like if the thing goes to zero kind of thing. But having said that, the fact that they do have that confidence in their own company and they're happy to put a bit of extra savings in from time to time, I think is a positive. It's a positive, but yeah, like overall, I wouldn't read too much into it. And for this one, for me, it's a rates go down stock. When we get to that point when, look, nobody knows exactly what's going to happen. Quite possible what happens, they want to get inflation under control, up the rates. People are hurting. Oh no, recession. Oh, okay, inflation's dropping and there's a recession. Everyone's like, oh, how dare the RBA? Like my house went down in value. Like anger. Like the Greens are proposing that we make it illegal to put interest rates up or something. And and then they'll actually start putting it down, and that's when I reckon that's when I'll be definitely if I don't start to buy Dicker Data, like maybe I've missed it or something. But if it was, generally speaking, because Dicker Data uses so much debt to fund its business, hold all that inventory, lower interest rates, just that's extra profit for them.
You know what? It's nice to see, obviously, them buying, but it's now coming into a bit more value, DDR. It used to be, it's probably just over expanded too much P-wise for me, right, during the good times. Because I like the company like you do. I think overall, definitely great management. But like I said, just going to run too hard, too fast over the last two to 3 years, where,
well, the other thing is, that
it was only growing by 20%. It wasn't.
Yeah. Well, but the other thing, Peter, is like sort of the revenue's still good, but the thing is, what's happened is because of those interest rate rise and a few other things, but mostly the interest rate rise, they're over earning for a while. They had great demand. Their warehouse was chock-a-block full. They hadn't yet started the expansion of the new warehouse, so they were sweating their assets really hard, and interest rates were low. So that's got the best ever margins that they had. And that's the best they can do, is sort of net profit before tax margins of a bit over 4%. Things go a bit wrong, not wrong, but things get less favorable. That net profit before tax margin moving back towards 3%. But that's a 25% reduction in margin. Now, it hasn't been quite that bad, but it might seem 3 to 4% is a little difference, but it's big for their profit.
But cyclically, this is probably the right thing, the right time to have start looking at this, because we're getting closer to that, over that, hopefully inflation, and over that interest rate rises, and now it's on a P of 19, possibly now 18, maybe, right over the next 12 months. So, and dividend of 7.4, fully grossed up.
Yeah.
So this is where it's starting to get interesting. So I'm actually putting this on my list as one to watch very closely once it starts turning back up, because like I said, it's a quality company. We should be looking at things like
I agree. And once interest rates peak, it's all upside for these guys. They get more profits, and their dividend yield, which is like, whatever grossed up 7 point something at the moment, that starts to look even more favorable if, you know, you suddenly only get 3% or 2% in the bank.
Absolutely. All right, look, we found a good one. All right, but it's just not there yet at the moment, technically wise. So we'll definitely put it on a watch list because it could get a little bit lower, maybe $7, but it is there to be bought at a certain stage. All right, let's go to another one. Give me another one.
I'll tell you one I really dislike with a passion, FLN. That has got directed buying. It's a
really?
held.
No, I don't even want to talk about that. That's just rubbish.
Complete. Like, anyway, just you can just chuck on the long-term chart as well and see how bad it is. So this is a hard avoid. Hard avoid for me. Okay, enough said.
Such an underperformer over a long period of time.
Doesn't matter. The director's buying shares, mate. I'm not going anywhere near it. And it might spike up. You can see it spikes up sometimes, but it always comes back down.
Oh God.
A good one which I know you like and wanted to talk about, DTL.
Oh yes. Now, this is very, very interesting because it was, I think, hot stock, right? And I've been buying some in the fund as well. And I think you're going to say that the director's been buying at the top. What's going on there? Please tell us.
Well, I mean, I think this is the Choice IT Services distribution company in Australia. It's huge. It's so big now that it basically, you could think of it, it's clipping the ticket on IT spend of government and big corporates. So that's a great tailwind to be a part of. Their most recent results were absolutely cracking. I'm talking in the February results. Second half, you're going to see that, you should see that cash flow come through much stronger. That's the normal pattern for them. And basically, as this is a long-term performer, it's one that I would really like to have in my portfolio. And literally the only thing that is a negative that I can think about is that it's traditionally has not had such a high PE ratio as where it does right now. And it's about 27.5 or something like that. So look, it's a little on, I think that's actually from the annuals. So maybe not so bad if you look at the most recent half actually, but it's not even half to half. So, you know, take it with a grain of salt. Either way, what I'm trying to say is, look, oftentimes these kind of businesses, they're trading on closer to 15 to 20 times earnings. These guys are definitely well above that. I don't know if you can chart their PE ratio over time. Let me see.
It's always been up.
Yeah, like
it's not nothing new for these guys.
Yeah, so basically, like, all I'm saying is, you know, they clearly have had a bit of a re-rate in terms of, you know, the multiple they're getting in the market there. Just look at this over time. So like historically, Data 3 has had, sorry, I'm just getting this up now. Like if we use last 12 months EPS, yeah, they're like around 30 at the moment. And last 12 month EPS, yeah, 30 at the moment. But if you go back in time, sort of by further than that, you know, once upon a time, these guys were on like 13 or even much lower than that. So yeah, like there has been that re-rate, and so you're not going to get that re-rate again. Worst case scenario, it goes back to the old ways. That's probably unlikely. Probably the re-rate is now, it's a bigger company. It's sort of in the ASX 200, or I don't know if it is in the ASX 200, but it's, you know, getting in the indices. And so yeah, I don't think you're necessarily getting that re-rate again. So maybe just more ordinary returns with that system growth of IT spend in Australia, which I'm not against either, by the way, and quite like.
Yeah, no, I agree. Quality company. And I think if you bought it on a hot stock, still a keep. It's still technically absolutely sound. In fact, if you haven't bought it on anything, I've been nibbling here because I think, you know, when you see a director buying at 760, whatever it is, that gives you a bit of confidence. You go, I'm going to do the same.
I believe this is a long-term hold.
Yeah.
And that I would not be opposed to even pretend. I'm not like, I haven't recommended it or anything, but like I also lean to buy.
Yeah. And, you know, long-term, what a great looking
But just long-term.
Yeah. Long-term, great looking chart. Look, it's a lot of positives going for it. And I agree. I think the IT space is actually quite good. You know, it's a dominant player in this space too. So you're picking up a lot of tick boxes here. You know, good company, good management. good results, good chart. I mean, there's so many things to like about it, and the directors are buying that. This is probably on top of my list to really probably have a look at. DDR I like, but it's just trending below, so it's just there's no momentum there. But this one does have a momentum and a little bit of pullback. Probably an opportunity to actually get some. All right. Have you got another one?
Yes. We're not one as good. All right, let's do AFL. Oh no, CGF. Because that's good.
Okay. Go on. Give me
this one. The chart is no good, but the angle here is annuities, basically like the aging population, more demand for annuities, that kind of thing. Also, maybe with rates higher, they can offer high rates, annuities more attractive. Might be part of the theory as well. So yeah, and also we did see a bit of director buying, which is how come we're talking about it right now. So they're a decent long-term business. You could think of Challenger itself probably more as a dividend stock. So you got your 4% yield. Might not be enough to be attractive, to be honest, but I don't know what you think.
Yeah, look, I don't mind the company. It definitely serves a purpose. It's got annuities like you said. Definitely, maybe you can call it a little bit defensive versus, I don't know. I mean, it's got a couple of moving parts in there. So it sometimes works, sometimes it doesn't for me. But overall, I think there's better companies out there, to be honest. Even though the director's buying and the chart doesn't look fantastic. So I'd probably put it lower down the track somewhere for me to have a look at. Definitely prefer the DDRs and DTLs that we've mentioned today. But it's interesting anyway that, that maybe there's a bit of positivity thinking that the company is going to deliver a decent result, because you would not be buying your own shares unless you're thinking that you're going to, you're on a good wicket, really, at the end of the day. So interesting again. So thank you for that, Claude. We'll call it right now. That's the end of that. A pretty interesting exercise to just go through some of these stories to see who's buying what in which companies. And we've identified a couple to have a look at for sure. So thank you for that, Claude. I will let you go, and thanks guys for joining me. Have a great end of the rest of the week, and hopefully the market recover a little bit. Other than that, great trading. Thanks, guys.
Thanks for watching, everyone. Have a good day.
Cheers.